What's the best way for beginners to start investing online with just $100? As a millionaire investor, this is something I get asked all the time. Today, I'm going to compare the results from 5 investments you can make from your laptop and try to answer this question once and for all. We're going to be using this grid to judge each one in these categories. First up, learning curve. Next is passive income potential, which is how much money an investment can earn for you passively while you still own it. Then, there's tax efficiency, which refers to the specific tax advantages or benefits available for each type of investment. After that, we have risk level, which is about how likely you are to lose money and how much the investment's value might fluctuate. And finally, we're looking at the results. This is where I'll reveal my percentage return over the last 4 years and exactly how much my $100 investment is now worth. Alright, let's kick things off with individual stocks. The idea of finding the next Apple or Tesla and watching your $100 skyrocket is super alluring. But hold your horses, because individual stocks come with a steeper learning curve than some other options. Think of it like learning to ride a bike. You wouldn't just hop on a mountain bike and tackle a black diamond trail on your first try, right? Same goes for stocks. You gotta understand things like market cap, price to earnings ratios, and balance sheets. Now the good news is, we live in the age of the internet. There are tons of free resources out there, like YouTube channels, educational websites, and even demo accounts that let you practice trading with fake money. So, what about passive income potential? Well, some stocks pay dividends, which are like little bonuses companies give to their shareholders. And obviously, if your stock goes up in value, you can sell it for a profit. But remember, with individual stocks, you're putting all your eggs in one basket. If that company goes south, so does your investment. Tax-wise, it depends. Short-term capital gains, meaning you sell within a year, are taxed as ordinary income. Hold for longer than a year, and you get taxed at a lower rate. Now let's talk risk. Individual stocks can be volatile, my friends. Remember GameStop? That's why it's crucial to do your research, pick companies you believe in, and maybe even consider diversifying into a few different stocks instead of going all in on one. And for the moment you've all been waiting for, the results. My $100 investment in a single stock, well, it's had its ups and downs, just like the stock market itself. I'm not gonna lie, it's been a bit of a roller coaster ride. But hey, that's the stock market for you. Now let's move on to a more passive way to dip your toes into the real estate market without actually needing to buy a whole property. Let's talk about REITs.
Check one, check.
Alright, let's talk about real estate investment trusts, or REITs for short. Now, I know what you're thinking. Real estate, but I only have $100. And you're right, buying a whole apartment complex is probably not in the cards just yet. But that's the beauty of REITs. You get to own a tiny slice of the real estate pie without needing to qualify for a mortgage or become a landlord. Think of it like this. Imagine a giant skyscraper downtown. Instead of one person owning the whole thing, it's divided into thousands of little pieces, and you can buy one of those pieces with a REIT. You're essentially pooling your money with other investors to own a portfolio of income-producing properties, like apartment buildings, shopping malls, or even cell towers. Now, the learning curve for REITs is definitely less steep than for individual stocks. You don't need to be a real estate mogul to understand the basics. Just like with any investment, it's always a good idea to do your research and understand things like the REIT's portfolio, its management team, and its track record. Here's where REITs get interesting passive income potential. Remember those dividends we talked about with stocks? Well, REITs are legally required to pay out a significant portion of their profits as dividends to shareholders. Tax-wise, REIT dividends are generally taxed as ordinary income. However, there are some REITs that are structured as partnerships, and those can offer some tax advantages. Now let's talk risk. REITs, just like any investment, come with some level of risk. They can be affected by things like interest rates, economic downturns, and changes in the real estate market. However, because REITs are required to pay out most of their profits as dividends, they tend to be a bit less volatile than individual stocks. So how did my $100 REIT investment fare over the past 4 years? Well, it's been a pretty solid performer, delivering consistent dividends along the way. It's not a get-rich-quick scheme, but it's a nice way to add some diversification and passive income potential to your portfolio. Okay, ready to dive into the world of digital currencies? Let's talk about cryptocurrency. 15. Chapter 3. Cryptocurrency, the Wild West of investing. Alright, strap in because we're about to enter the world of cryptocurrency, the Wild West of the investing world. Now I'm sure you've heard all the buzz about Bitcoin, Ethereum, Dogecoin, and the thousands of other digital currencies out there. Some people say it's the future of money, while others think it's a bubble waiting to burst. Cryptocurrency is basically digital money that uses cryptography for security. It's decentralized, meaning it's not controlled by any government or financial institution. And it operates on a technology called blockchain, which is like a public ledger that records all transactions. The learning curve for crypto is definitely steeper than for REITs or even individual stocks. You need to understand things like blockchain technology, different consensus mechanisms, and how to store your crypto securely in wallets. But here's the thing about crypto that gets people excited, the potential for massive returns. We've all heard the stories of people turning a few $1,000s into millions by investing in Bitcoin early on. And while those stories are definitely out there, it's important to remember that crypto is incredibly volatile, like buckle your seatbelts and hold on tight volatile. The value of cryptocurrencies can fluctuate wildly based on things like news headlines, regulatory changes, and even Elon Musk's tweets. So while the potential for big gains is there, so is the potential for big losses. That's why it's crucial to only invest what you can afford to lose and to have a solid understanding of the risks involved. Tax-wise, crypto is still a bit of a gray area. The IRS considers it property, so you'll owe capital gains taxes if you sell for a profit. So, how did my $100 crypto investment do? Well, let's just say it's been an interesting ride. It's experienced some pretty dramatic swings, both up and down. But hey, that's the nature of the beast. Now let's move on to something a little more stable: gold. Chapter 4, Gold, the OG Safe Haven Asset. Alright, let's talk about gold, the OG Safe Haven Asset. For centuries, gold has been seen as a store of value, a hedge against inflation, and a safe place to park your money during times of economic uncertainty. Now, when it comes to investing in gold, you've got a couple of options. You can go the traditional route and buy physical gold like coins or bars. Or you can invest in gold ETFs, which are exchange-traded funds that track the price of gold. Physical gold gives you that tangible feeling of owning something real, and it's a great way to diversify your portfolio outside of the stock market. But it can be a pain to store securely, and you'll likely have to pay a premium to buy and sell it. Gold ETFs, on the other hand, are much more liquid and easier to trade. They also typically have lower fees than buying physical gold. However, you don't get that same tangible ownership experience. The learning curve for gold is relatively low. It's a straightforward asset to understand. You basically just need to keep an eye on the price of gold and decide whether you think it's a good time to buy or sell. Passive income potential with gold is pretty limited. It doesn't pay dividends or generate any cash flow. The main way to make money from gold is if its price goes up and you sell it for a profit. Tax-wise, gold is treated as a collectible by the IRS. That means you'll owe capital gains taxes on any profits, and the tax rates are different for short-term versus long-term gains. Risk-wise, gold is considered a relatively safe investment. It tends to hold its value well during times of economic uncertainty, and it can act as a hedge against inflation. However, its price can fluctuate, and it's not uncommon for gold to go through periods of stagnation or even decline. So, how did my $100 gold investment perform? Well, it's been a steady performer, slowly but surely increasing in value over the past 4 years. It's not the sexiest investment, but it's a solid addition to any diversified portfolio. Now let's wrap things up with the king of long-term investing: index funds. Chapter 5. Index funds. The set-it-and-forget-it approach to investing. Alright, let's talk about index funds, the set-it-and-forget-it approach to investing. If you're looking for a simple, low-cost, and effective way to grow your wealth over the long term, index funds are your new best friend. So, what exactly is an index fund? Think of it like a giant basket of stocks or bonds that tracks a specific market index, like the S&P 500 or the Dow Jones Industrial Average. When you invest in an index fund, you're essentially buying a tiny piece of all the companies included in that index. Now, the beautiful thing about index funds is that they're incredibly diversified. Instead of putting all your eggs in one basket by investing in a single stock, you're spreading your risk across hundreds or even thousands of companies. The learning curve for index funds is about as low as it gets. You don't need to be a stock market wizard or spend hours researching individual companies. Just choose a reputable index fund that aligns with your investment goals, set up a regular investment schedule, and let the power of compound interest work its magic. Passive income potential with index funds depends on whether the fund pays dividends. Some index funds reinvest their dividends, which helps your investment grow even faster over time. Others pay dividends out to investors, providing a source of passive income. Tax-wise, index funds are generally very tax efficient. Because they're not actively managed, they have lower turnover rates, which means you'll owe less in capital gains taxes. Risk-wise, index funds are considered a relatively low-risk investment, especially over the long term. They're inherently diversified, which helps to mitigate losses. However, it's important to remember that index funds can still go down in value, especially in the short term. So, how did my $100 index fund investment perform? Well, just like clockwork, it's steadily climbed higher over the past 4 years. It's not the fastest growing investment, but it's a reliable workhorse that's built for the long haul. And there you have it, folks, a 4-year update on my $100 investment experiment. So whether you're diving into individual stocks, buying some REITs, exploring crypto, getting into gold, or sticking with the steady reliability of index funds, each investment has its pros and cons. Some are better for growing your wealth quickly, while others are designed to protect it over the long term. The most important lesson is to start early. Even small amounts like the $100 we've been working with can grow into something significant thanks to the power of compounding. Time is your best friend when it comes to investing, so don't wait to get started. If you want to know what the laziest way to make money online is, then I'm gonna leave that video right up there. But don't click on it just yet. And hey, if you enjoyed this video and want to see more content like this in the future, be sure to give it a thumbs up and subscribe to the channel. Until next time, happy investing. 8.